12:30 sharp. So let's start this today's session. Ladies and gentlemen, welcome to the Foreign Correspondents Club of Japan in Tokyo. My name is Stefano Carrer. I am a journalist correspondent for the Italian economic daily newspaper Il Sole 24 Ore. Today's session topics is Forex, the foreign exchange market, and we have with us two prominent experts on this field. One is Shusuke Yamada, is the chief Japan Forex strategist for the Bank of America Merrill Lynch group. And the other one is Mr. Yunosuke Ikeda, that is the head of Forex strategy at Nomura Securities. They tend to have, I understood, quite different views on the short and medium term trend of the exchange rate of the yen, so it will be interesting to listen how they will make their case. So, Forex market. Forex market is one of the most unpredictable market. So their job is a very tough job, almost impossible. I mean, because why? Because the Forex market is not a free market. It's not a market where prices are set by the law of supply and demand set by private players. There are many factors that influence the market, and especially monetary policies and expectation on inflation, and so often the trend is not really reflecting the fundamentals of the single economies. And this is especially true in Japan, where in the past many times when the Japanese economy was booming, the yen was weak. When the Japanese economy was very weak, the yen was very strong. So in this moment, the yen is again under the spotlight. Why? Because after almost 3 years of weakening, thanks to the QQE policy introduced by the Bank of Japan, now the trend seems in reversal, and officials at the finance ministry and in general the Abe government is very worried that a strong yen could aggravate the problems of the Japanese economy that is on the verge of recession again. And so they, even also today and yesterday, some official resorted to some sort of so-called verbal intervention. So they threatened to intervene directly in the Forex market. But that will be quite difficult because after the G20 financial summit in Shanghai, everybody pledged not to manipulate currency. And also Japan is hosting at the end of May the G7 summit. So if they want that the summit will be smooth, probably it will not be a good idea to irritate Americans and Europeans with direct intervention. So, with no further delay, please give a very welcome to our guests, Mr. Yamada and Mr. Ikeda. So, first, please, Mr. Yamada, if you can start your speech.
Okay, so ladies and gentlemen, thank you for coming to our session today. I'm quite excited about speaking to the respected media group, and also, excited about having a session with Ikeda-san today. So today, I think I will first talk about my currency view. I'm bearish on the dollar yen still, down to 100 to 105. Okay, and then as you know, Japanese politics is becoming quite interesting in the financial market. So I will briefly review how politics can impact Japanese markets. And I think last time I checked, dollar yen was trading mid 109. And it's an interesting time to talk about FX. because I was back at my home in Ishikawa-ken, where I grew up, and I was talking to my friends from high school, and one of them is running a kushiage shop, right? And until recently, he didn't have any foreign visitors, but starting from last year, he started to see increasing number of foreign customers, and that's really changing their life. They're trying to learn English, trying to reformat the advertisement so that they can invite foreign customers. So I think the foreign exchange rate is clearly changing our day-to-day life. And 2016 is a very, very challenging year for us and for anyone in the financial market, in a sense that you have to have different views for different time horizons for the Japanese yen. Let me be just clear on the structural view. Over the very long term, I think the Japanese yen's structural weakness is far from over. Japan has demographic constraint and also high public debt. This basically means financial repression is going to be the basic national macroeconomic strategy for years to come. Okay, but 2016 is different. This year, the global factors are driving the FX market, and this is still bearish dollar yen in my view. And I will explain my view. Back in 2015, the end of 2015, we did expect Japanese yen to be the strongest currency in 2016, but so far so good. But what's been really fascinating is the extent of U.S. dollar's weakness. It's basically depreciating against major currencies. And I think the U.S. dollar's weakness is, it is a consequence of perceived shift in the Federal Reserve's policy, right? And this perceived shift in Fed's policy is driving the market. And some in the financial market expect or speculate that there might have been an agreement on the US dollar's weakness in the G20 meeting in February. Whatever the truth is, it is the key topic in the financial market. And this is definitely negative for the US dollar at the moment. But at the same time, I would say this Fed's dovish shift is not enough to weaken dollar yen to 100. Okay, it's not really outright yen bullish. It is dollar negative, but it's not yen bullish. But there are other factors that make me believe that dollar yen can test as low as 100 this year. Okay. First of all, I think at least the dollar yen and probably some other risk markets as well, we are in a bear market. And we're not just talking about chart analysis. If you look at investor positioning, it is quite telling. And by investor positioning, I'm not talking about speculators. It's more long-term investors positioning for risk assets. And this is probably true for the rest of the world as well. But Japanese investors in Japan, domestic investors have accumulated significant amounts of foreign assets and risk assets over the past 2 years. Roughly 16 trillion among real money community, as you see in slide 5. Okay. But then the global condition has changed, and market levels are much lower than during the good times. And this really suggests the natural investor response is to be defensive. So sell on strength pressure will probably intensify when the dollar yen increases, but when the dollar yen falls, deep buying probably wouldn't emerge as quickly. And this basically means dollar yen's supply-demand balance is not likely to improve anytime soon. Okay. And second, we always talk about ECB, BOJ, Federal Reserve, but it's quite important to at least keep in mind that at the moment, the financial market is driving economy and politics and policy, not the other way around. And this is a significant difference from last year. Marginal return of monetary policy is clearly diminishing. So, for example, until last year, we all remember that, including myself, we listened to the BOJ and we acted as the BOJ wanted. Okay. But this is no longer the case. The key theme in the financial market last year was don't fight the central bank, I would say, until the first half of last year. But this year, the limit of monetary policy is really the key focus in the financial market. Okay. And it seems that in the FX market, the market is just trying to correct dislocation, which is partly result of diverging monetary policies until last year. So Japanese yen still looks inexpensive, and the US dollar still looks expensive, meaning dollar yen still looks expensive. And it seems that it is gravitating towards 100 to 105 range, where it looks no longer expensive. Okay. And finally, the global macro condition is not stable at the moment, and it is not good enough to attract money into risky assets. I'm not going to go into details of economic argument, but if you look at the Japanese yen and Japanese equity, it is clear that we all know Japanese interest rates are excessively low, and money is supposed to fly into risky assets out of JGB, but it's not happening. One good reason is because it's the defensive nature of investors. Return of capital is still important, more important than return on capital. And the global macro condition is not convincing enough to change this very basic dynamics. And this movement in the FX market is spilling over to other parts of the financial market, most notably outperformance of the US equity and underperformance of the Japanese equity. Okay. Now, if we assume that we are in a bear market, how can this end is our question. And there are roughly two scenarios. One is the market adjusts to the level where the risk assets look attractive to everyone. In case of dollar yen, I think dollar yen or US dollar look attractive below 105 against Japanese yen. And at that point, I do think sizable money will come and buy US dollar. And that's probably where this pair, dollar yen, balances out and get basically neutralized. But as you can imagine, that extent of yen strength is unlikely to be without significant pain in the equity markets. The happiest scenario is probably some big events happen to change market assumption, including myself, investors, and economists. And what could be these big events? We have the G7 summit in May in Japan, which is one big opportunity, but presidential election is going, and G7 doesn't involve important country, which is China and other emerging economies. So I would say more realistic event of focus would be the G20 summit in September. But we are still 5 months away until that forecast event, and several things can happen to really push dollar yen lower to 105 and potentially to 100. One, seasonality will become positive for Japanese yen and negative for risk assets, starting in May, sell in May, including oil price. And secondly, the market basically assumes the Fed has shifted to a dovish stance. So the currency market's reaction to US economic data is likely to be asymmetric, so reacting to more negative data and not reacting to good US data. And three, the global equity has been recovering, but it's questionable how long it can go. As I said, marginal return of monetary policy is diminishing, and how much the dovish Fed can do to the global equity market is, at least questionable in my view. And then fourth, the BOJ is in a very, very difficult position, I think. If you look at the market, economy, and politics, there's every kind of pressure on the BOJ to implement some kind of easing. But at the same time, the BOJ's ability to influence the financial market today is much smaller, at least for the time horizon of 2016. And then finally, there is uncertainty around Japanese politics, and the volatility can rise into a possible double election this summer. And I will briefly touch on the on politics. And as you know, the financial market has not focused on Japanese politics for the past year, but suddenly the focus has come back in, just because the chance for tax hike delay, supplementary budget, and also the double election is increasing. Okay. And I would say this is still uncertain. Politics you can never predict. But one important thing to remember about this potential double election is that this time around, unlike in 2014, the coalition, the ruling coalition's big victory probably doesn't lead to outright risk on market. The very simple reason is that Prime Minister Abe's big victory probably has implication for strong political stability, but also for higher chance of constitutional revision. And its impact, long-term impact on the equity market and currency market is not something we can measure today. But uncertainty is probably be the first thing that the market will price in, which probably means supportive of Japanese yen. So overall, my view is that at least this year, dollar yen will have difficulty recovering its structural upward trend, and that we should see the downside risk to 105, but potentially into 100. And at 100, I do think the risk will neutralize from the fundamental perspective. It's in terms of valuation, it looks inexpensive. So we will see more Japanese money buying dollar yen from the very long-term perspective. And then the intervention probability will increase at 105, but decisively into 100. At the moment, the domestic political pressure to tame JPY strength is not enough to counter the diplomatic pressure to prevent any type of intervention. But that risk-reward, that balance will probably be neutralized at 105 and then reverse at 100. So, I mean, by no means the dollar yen sell-off is predetermined, but in my view, it looks likely that this pair is gravitating towards 105 and potentially to 100. And there are other cases against my view, reasonable cases. But for this, I can probably stop here and hand to Ikeda-san.
Thank you. Thank you for your introductory remarks, and we will come back on some of the topics you said. And so, please, Ikeda-san. So.
Okay. Thank you very much. Just a brief introduction of myself. I joined Nomura in '95, and since then I've been doing all Japan macro research for 20 years. From 2003 to 2008, I was based in London, where I covered U.S. and European investors, and I discussed lots of things regarding the Japanese macro and also Japanese yen. So I'm fairly sure I'm fairly good at replying to your very hard questions or sarcastic questions as well. Anyway, a little bit different from my side regarding the general risk sentiment. I have a fairly optimistic view in the global risk situation. The main two reasons why the market was so pessimistic until the early this year was the uncertainty related to the Chinese economy. I think now the situation is improving greatly, in particular after the Chinese government made it very clear to underpin the economic growth rate at least 6.5%. And also the kind of a market concern about the potential recession in the US. And latest data set from the US are clearly I would say, denouncing the possibility of the U.S. Slipping into recession. So I have a fairly optimistic view on the global economy and financial situation. And from here, I'd like to address 5 key points related to the Japanese yen. First, why dollar weakened so much. Second, why yen strengthened so much. And third, anything very different in the Japanese institutions or flow picture, etc. So that's the third point. And the number 4 point is my outlook for the dollar yen related to policy responses from both the US and Japan. And finally, in number 5 is the brief overview of the flow picture in Japan and the outlook for those important flows related to investment and also corporate related flows. So the first point is the dollar weakness. So as of the end of last year, beginning of this year, my forecast for the dollar yen by the end of this year was standing at 130. And surprisingly, however, there has been a very consistent weakness of the US dollar. But it's very important to break this dollar weakness period into 2 different phases. In January and February, it was general risk-off sentiment. So it was not a very big surprise for investors to set off chance of US rate hikes, and people bought Japanese yen. Japanese yen is still regarded as a safe haven currency. The second phase, in March, is a very different behavior in the FX market. This is a general sell-off of the US dollar. The key theme is the unsustainability of the dollar strengthening. People are really focused on the implication of the strong dollar on the US economy. And the people are really focused on the FOMC communication and also Janet Yellen's speech, etc. And they are really impacted by the dovishness of the Federal Reserve monetary policy stance. However, there are 2 very, I would say, important misunderstandings. Firstly, the dovishness of the FOMC is very artificial. I would say this is a politically demonstrated dovishness of the FOMC. I think the key trigger for this artificial dovishness was the Shanghai G20 meeting, in which I think Janet Yellen was asked to demonstrate her dovishness in FOMC and also her speech, etc. So overnight, we saw the latest FOMC minutes, which skipped the rate hike action. That's for March FOMC. And the reason why the FOMC lower the expected rate hike path compared to the December policy setting meeting was the consideration of market concerns in global economics and also financial situation. So it's interesting that the FOMC is stressing the importance of market concerns, market participants' concerns, probably G20 nations' concerns about the global economic and financial situation. But I tend to think this dovishness is not necessarily coming from the U.S. policymakers' assessment of the U.S. economic situation or U.S. Inflation outlook, etc. Therefore, once the market situation stabilizes, I tend to think there's a very high chance of FOMC regaining back some hawkishness or willingness to normalize the interest rates going forward. So that's one thing. The other market misunderstanding is the impact of the strong dollar on the US economy. So many commentators always write about, oh, US economy is weakening because of the strong dollar, or ISM manufacturing recovered because of the decline in US dollar, etc. But that's a very wrong observation. It's very true that there has been a very strong negative correlation between the value of the dollar and US manufacturing index, for example, represented by the ISM manufacturing. But this is a very superficial, inverted correlation. The truth is, decline in oil prices has been the very, I would say, persistent headwind for the US manufacturing activity. Therefore, if you have a look at the relationship between the decline in oil prices and weakness of the manufacturing indices, there has been a very strong correlation. The problem is, if you talk about the dollar value in a trade-weighted basis, the trade-weighted basis of the dollar value has a lot of Canadian dollar and the Mexican peso, who are extremely sensitive to the fluctuation of oil prices. So every time oil prices go down, there will be automatic boost to the dollar on a trade-weighted basis, because Canadian dollar will fall and the Mexican peso will fall in line with the decline in oil prices. Just for your information, 25% of trade-weighted basket of the dollar calculation is against Mexican peso and a Canadian dollar, those two oil-producing countries. So that's the reason why people are so, I would say, convinced that strong dollar cannot be sustainable, because strong dollar will slow the US economy. Then the next rate hike will be impossible. That's kind of argument. Okay, now I'd like to talk briefly about why yen strengthened in the first quarter of this year. This is basically because of, in my interpretation, the dissolution of Kuroda magic. So, until the end of last year, yen had never been bought by speculators. So if you have a look at, for example, Chicago future market, IMM kind of data, since the start of Abenomics back in October or November 2012, the spec positions had always been in short territory for the Japanese yen, and those spec players never tried to buy Japanese yen. But the situation completely flipped in December last year. The pivotal point was the announcement of the supplementary measures by the BOJ on 16th of December. There was a kind of a fine-tuning policy accommodation by the BOJ that sent a wrong message to the market. Market started to believe, oh, bazooka is not coming. And then people became, I would say, comfortable to start buying Japanese yen. Now, therefore, in a risk-off sentiment, Japanese yen is a typical currency to be bought by speculative players. So this is a reason why yen now has a tendency to strengthen as a reaction to risk-off sentiment. And also, when people want to sell dollar, Japanese yen is a good choice of currencies to buy. Okay, so I described what's going on in the speculative market in particular, but some commentators argue that now flow situation in Japan has changed from yen negative to yen positive. But I disagree with that idea. If you have a look at Japanese institutional money investing in foreign bonds, it is significantly accelerating rather than repatriating. So from the start of February, so basically after the announcement of the negative rate policy, the cumulative amount of Japanese institutional money investing in foreign bonds is as much as 10 trillion yen, okay, 10 trillion yen or 2% of GDP. So apparently the flow is now accelerating towards outside of JGB and more investment in foreign bonds, in particular US bonds. However, as Yamada-san pointed out, there was no impact on the dollar yen. This is because of the hedging activity. They are uncertain about the yen depreciation trend and general highly elevated level of the volatility is the reason why they love to attach currency hedges. However, this shift out process will likely continue in the future. I'd like to point it out later. So number 4 point is policy responses. Okay. From April to July, this is a season for politics, both in the US and Japan, in particular in Japan. First, April FOMC. I'm fairly sure it will deliver a fairly hawkish message to the market. Overnight, we saw latest FOMC minutes. What was really surprising was the active discussion of whether to raise interest rates in April or not. It's very unusual for FOMC to discuss the future action rather than today's action. So that was pretty much indication of the FOMC's bias towards normalization of the monetary policy. And with regard to Japanese political action, first, we will have a BOJ meeting in April. Some people are skeptical about the BOJ's delivery of the additional easing because of the G20 agreement or G7 agreement, etc. But the matter of fact is, when the last time ECB delivered comprehensive easing measures, that was right after Shanghai G20 meeting. So I don't think the BOJ is now restricted by G20 agreement or something like that. Still, any G7, G20 country has freedom to do additional easing. Of course, currency intervention will be very, very difficult because any G7 nation will need to get approval from a counterparty nation. In Japan's case, that's the US. It will be very difficult until the dollar yen undercut below 105 or something like that. So far, I don't expect any currency intervention. However, additional easing should be quite possible in April. And in May, of course, G7 summit, Prime Minister Abe will host that summit. Therefore, for him, it will be an extremely ideal timing to show initiative by announcing fiscal measures, impressive fiscal measures, potentially including the further delay of the consumption tax hike. And then potentially the announcement of the double election in July. So this series of policy responses, BOJ, fiscal stimulus cancellation or delay of the VAT hike, and also snap election, this pretty much looks similar to the one we had in October to December 2014. So it may be a kind of a reacceleration of Abenomics to some extent, in my view. And if this will be combined with a fairly, I would say, optimistic assessment of the U.S. economy and the normalization of the U.S. monetary policy, the dollar yen will naturally start to reverse its course to the upside. That's how I look the dollar yen. And finally, the impact of the negative rate policy. It's already pushing Japanese money out from the JGB market for sure. As I touched upon, 10 trillion yen net investment since the announcement of the negative rate policy invested in foreign bonds. And as I see, private pensions, regional banks, and life insurance companies, basically all of them are investigating how to get out from the JGB market, in which yields are negative everywhere, up to 10 or 11 year JGB. And historically, there has been a very strong relationship between the level of the JGB long-term yield and Japan's investment in foreign assets. So although so far it's FX hedged basis, but eventually cost of a hedge will rise because of the concentration to FX hedged foreign bonds investment. Then I think investors will gradually shift out towards unhedged investment in foreign assets as well. And all in all, if you assess two biggest fundamentals of the JPY, the one is the rate differential. The second is the flow fundamentals of the JPY. Both are suggestive of the sustained yen weakness. Therefore, the last element of the JPY, which is the speculative element and the speculative players, when they start to reverse their, I would say, positions, the yen is a very likely currency to start weaken. And my forecast is 122 for the end of this year. Thank you.
Thank you, Mr. Ikeda. So our expert made a strong case in a smart way for their opinion, even if it's different. So it's, I think it is an interesting introduction to the Q&A section. So let's proceed with the Q&A section. First, the media representative. Any question? So maybe I will start. Because I was thinking to highlight why, contrary to everybody's expectation, contrary to the expectations of Governor Kuroda, the introduction of the negative interest rate policy has not provoked the side effect of a weakening of the yen, and quite the contrary. So what do you think, we'll ask to both of you, was the main factor, main reason for this unexpected outcome of, and what do you think in general of the negative interest policy in the Japanese financial system?
Okay, so I will probably start. And the reason why the negative interest rate introduction hasn't led to higher dollar yen or weaker Japanese yen, there are multifolds. First of all, the problem we're facing right now in the world is, in my view, the lack of aggregate demand. And in this situation, even if Japanese yen successfully weakens, that's gain for Japan, but that's someone's loss. And when you see, demand lacking, this will probably lead to some weakness in equity markets in other parts of the world. And this can lead to sort of competitive devaluation pressure on the Asian currencies, which will probably be negative for the global equity and snap back to the BOJ. So that's one reason. The other reason is the negative impact of the negative interest rate, which is diminished profitability for the banking sector and financial institutions, and reduced liquidity in the JGB market. The negative interest rate is definitely had some positive, but we do have some negatives as well. And I think, as I said, at the moment, return of capital is probably more important than return on capital, which means, we have 20 bips cut in the short-term interest rate, and we've seen quite drastic reduction in every part of the JGB curve. But that's probably not enough to really accelerate risk-taking. And finally, it's more the market psychology. In 2016, the BOJ is not in the central stage, not in the center on the stage in the financial market. Other things are happening in China, US, Europe, Middle East, and the BOJ's policy is probably 1 or 2 dimensions lower than these factors. And the last point is really retrospective, so we can't really fault the BOJ after the fact. But what has happened is the BOJ tried to defend 115. Whatever the truth is, that's our perception. That's the financial market's perception. They tried to defend 115, and they did not succeed. And that is retrospectively weakened the power of the BOJ's policy put, right? If they tried and if they couldn't do, then that has a psychological impact to the market.
Ikeda-san?
Okay, I generally agree with Yamada-san's view on how the BOJ's negative rate policy failed to reverse the yen trend. On top of his points, I tend to believe the timing was a little bit unlucky for the BOJ, because right before the BOJ's very decisive policy announcement, a day before, there was a very shocking news from the Deutsche Bank. Very shocking, disappointing earnings, or actually earnings result for full year 2015. And the people, I think, misconnected the central bank's negative policy to banks' profitability. Although the reality is the Deutsche Bank has something different rather than just being affected by the negative rate policy. But I think there was a kind of a increasingly fashionable discussion between the negative implication of the negative rate policy, in particular in the stock market and bank credits. So no wonder why when I visited hedge funds at the start of February, commentary was pretty much negative for the efficacy of the negative rate policy. And on top of that, I think the kind of a policy mistake on a perspective way is the BRJ didn't accelerated the purchase of ETFs. And therefore, on the announcement day, there was some disappointment because of the lack of the BRJ's commitment to underpin the equity market. Therefore, the kind of a risk of sentiment prevailed, and that was another reason of the, I think, Darien weakness in spite of the very impressive decisive action by the BOJ.
Okay. Please.
Thank you, Chairman. My name is Kobayashi at AOI Technos Research Institute. So let me ask you about to Mr. Ikeda. Okay, I had lectures of Ikeda twice. Okay, and I have a document of your forecast about dollar yen. Okay. So your forecast it 2016 130 yen plus alpha to 2017 130 yen plus alpha. So anyway, let me ask you about your analysis is very clear and very seem to be truthful. Okay, and I'd like to ask you about your how will you analyze the Chinese situation, China unrest? Okay, so the devaluation of China will be very long, and oil price also stay in the cheap level. No, one barrel, about $60. If they are up to $60, it still stay long. So many analysts say so. Okay, no. So in this case, how will you think? So let me ask you in Japanese. So do you understand my?
No, yes,
Yes,
perfectly
okay.
understood. Yes.
Okay.
So first, I'd like to address why I had to revise down my forecast from 130 plus alpha for both 2016 and 2017. Now I'm looking for 122 and 125. And also my view on the impact of the Chinese economic situation and the renminbi devaluation, etc., and our assessment of the impact of the oil prices on the Darien forecast. Firstly, as you addressed, it's very true that the decline in oil prices was very surprising to us. When we were looking for 130, our assumption level for oil prices was still standing at $60 per barrel. But now we are assuming roughly $40 per barrel. This $20 per barrel difference is very big. Basically, every $10 barrel drop in oil prices will have an impact on Japan's trade balance of around 3 trillion yen per year. So this total of $20 per barrel decline from 60 to 40 will improve trade balance by roughly 6 trillion yen per year. And this is, in my assessment, roughly having a negative impact on the dollar yen level by approximately 4 yen per year. So it's very true that one of the key reasons why we had to lower our dollar yen forecast is the lower assumption level for oil prices. And secondly, talking about the Chinese economic situation, last year the market was really surprised by the all of a sudden devaluation of the yuan exchange rate. However, the reality is that was just 3% depreciation of yuan, and that was pretty much in line with the decline in oil prices. And how I observe the PBOC's management of the yuan exchange rate was, if you look back the pattern of the CNY, it was clearly following the crude oil benchmark. So it looks as though from August to the end of last year, the PBOC was trying to align the CNY value with the fluctuation in oil prices so that it can offset any impact on import prices. And 4th of January, another surprise from the PBOC. I think that was the kind of Chinese authorities try to introduce market mechanism to the CNY. On the other hand, actually, the Chinese authority also tried to introduce market mechanism in the stock exchange market as well by installing this circuit breaker mechanism in order to allow free trade, the selling and buying in the stock market as well. In any way, my take is after the or around G20 meeting, now the Chinese authority is trying to align the CNY level with the basket of currencies called CFETs. So to me, there is no big uncertainty related to Chinese yuan. Therefore, it's no longer a risk factor for the risk sentiment in general for the dollar yen exchange rate either. And finally, I think I answered to both of your questions. Yeah.
Okay. Ambassador?
I'm Khalil Hassan, Ambassador of Bahrain. I enjoyed your both presentation. I have one question for Mr. Yamada and one question for Mr. Ikeda. Mr. Yamada, you said politics cannot predict. Somebody will say economics cannot predict. What's your comment? The second question for Mr. Ikeda. You know, in physics and math, you measure distance or size, or, by meters or centimeters or kilometers. Before, you measure currency by gold, okay? And this changed. Do you think this will come back to make the market more stable? Thank you, sir.
Okay, thank you, Ambassador. Very interesting question. But I think to answer your question, nothing is predictable. And that's why we sometimes resort to chart analysis, which is, in my view, most reliable in the financial market. But when we look at the economic performance, macroeconomic policy, fiscal policy, monetary policy, this year in 2016, very interesting way to look at what's been all happening is that monetary policy, fiscal policy, and the politics are basically forming trifecta, which means you see from the long-term political calendar, a double election is a strong probability, right? And if that is the case, consumption tax cycle delay is possible. it's a good theme for the election. But of course, the central bureaucracy wants to raise tax hike for a good reason, fiscal discipline. But everyone knows Abe administration's political capital is still very strong. So if they assume double election and delay in the consumption tax hike, you can sort of see negative interest rate is another form of tax, right? So of course, we cannot really predict, we couldn't predict negative interest rate introduction. And very, very hard to predict. But retrospectively, I think this year, what's going on in Japanese politics, fiscal policy, monetary policy, kind of all come together. And that's one of the reasons why we think the tax hike delay and double election is the chance is increasing.
Okay, from my side, thank you very much for your very insightful question. It's very important to discuss whether the U.S. dollar is a right gauge for any currency value, etc. Ideally, a currency without monetary policy is kind of an ideal gauge for relative value of any currency pairs. The problem of yen against the dollar is if dollar has a kind of a fundamental shift related to FOMC attitude, etc., the dollar yen will fluctuate, not just because of the yen size of the value. So gold is in that sense ideal because gold doesn't have any central bank. So there's no monetary policy, I would say, impact on gold. The problem around gold, however, is it will be affected by a real demand from industry-related demand for gold. So interestingly, in the last several days, in spite of the yen strengthening, gold has been fairly weakish, and this is partly because of the unwinding of bullish positions in commodities in general, which accumulated in the last several weeks. So US dollar is not perfect because of the noise around Federal Reserve monetary policy, but gold is also not a perfect measure to gauge any currency value because there will be impact from demand, real actual demand or industrial purpose demand for gold. So I think it's always better to compare any currency pairs to currency. For example, I tend to compare Japanese yen, not just against US dollar, but also Swiss franc, euro, or maybe gold to know what's really having impact on the Japanese yen.
And anyway, it's quite amazing that in spite of Japan being the most indebted country relative to the GDP in OECD, in spite of continuous downgrading in the past years of the sovereign rating, in spite of delays in fiscal consolidation, in spite of the kamikaze monetary policy of Kuroda, so the yen still enjoys this status of safe haven currency to be bought in time of market turbulence. So do you think that this will continue, or in the future there will be not such an automatical run to buy yen in times of market turbulences?
So from my side, the reason why yen behave like a safe haven currency is coming from two different aspects. Of course, both of they are connected to each other though. First is Japanese institutions tend to buy more foreign assets when the risk sentiment is better. So when economic situation looks good or the stock market looks encouraging, Japanese institutions tend to buy more foreign currencies, which will weaken the Japanese yen. So that's one thing. The other thing is it's related to market mechanism. When the volatility is very low, investors tend to buy high-yielding currencies because in a low volatility world, you want to earn carry with long positions in high-yielding currencies, and you may want to fund in low interest rate or negative rate currencies. And therefore, in a risk-on sentiment or lower volatility, yen is a currency to be sold, while, for example, Australian dollar is a currency to be bought. And in a negative situation with higher volatility, there will be unwinding of those optimistic positions, long Aussie, short yen. That will mean buying back of Japanese yen. Therefore, in a negative sentiment, typically yen tend to strengthen. I think this is the mechanism why yen behaves like a safe haven currency.
And what are the technical reasons why it's almost automatic that when the yen weakens, the stock exchange, Japan stock exchange tend to go up, and especially, I mean, when the yen tend to strengthen, the stock exchange tends to go down. Maybe.
Japanese equity or global?
Yeah, Japanese equity.
Well,
it seems that it's almost automatic. I mean, in
Right.
most cases, there is a strong negative correlation.
Yeah, I think part of the reason is explained by Ikeda-san just now. Yen is a safe asset and ultimate funding currency in the world. If you look at banking statistics from 2000, it's only the Japanese banks who have been consistently lending to the world. After the financial crisis, US and European banks have reduced foreign exposure, but Japanese banks are the only aggressive lender, which means when you have risk aversion, of course, equity markets decline and the funding currency will strengthen. And also internally in Japan, Japan is trying to exit deflation from years of deflation. And as a part of the national effort, the BOJ has been implementing aggressive monetary easing, which is negative for Japanese yen and positive for Japanese equity. At least investors do perceive this dynamics. So the positions are built on the assumptions that Japan will exit deflation on Japan's monetary policy and other policies. So when this reverses, naturally we see lower equity price and stronger Japanese yen.
Okay, please.
Gentlemen, thank you for the very clarifying and enlightening talk. My name is David Koo from the British Embassy, and I have two broad sets of questions that I would like to put to you. The yen has been behaving like a safe haven currency. And I was wondering, I know both of you did not touch on some of the geopolitical risks in Europe. For example, we have the refugee crisis, and perhaps quite pertinent to the UK, we have a referendum coming up in June. And over the next several, 3-4 months, that uncertainty is not going away. How much of a factor do you see that as weighing market sentiment? And underlying, if not a spike in demand for yen, at least a very slow erosion in the dollar-yen support. Secondly, back to Japan. Can I put the question again to both gentlemen? What does the Bank of Japan do when it runs out of JGBs to buy? There was some allusion to alternative assets like ETFs and so forth, but the JGB market is the largest and most liquid asset market, so any meaningful expansion in the monetary base surely has to come from comparable assets, which I'm not sure what they are right now. And so what would be the exit strategy? I mean, the IMF already has indicated or estimated that, the operational limits of QQE could come as soon as 2017 or 18. A former deputy governor of the Bank of Japan has estimated the limits might be hit as early next year. So I wonder if you have thoughts on that. And a related question is, nearer term, if we get another cut in negative interest rates from the Bank of Japan, let's say at the next 1 or 2 or 3 policy meetings, or an increase in the bond buying program, maybe they move from 80 trillion to 100 trillion a year, how would the markets react? What would dollar yen do in the case of that type of announcement? Thank you very much.
Who wishes to answer?
First question is to both, or?
Yeah, maybe to both. Whichever you decide to answer.
Okay. So let me answer the question on politics. And I think if you look at the world, geopolitical dynamics and actually domestic political stability, Japan, specifically the LDP-led Abe administration, is looking exceptionally strong. It has very strong domestic political base, and this is becoming more and more, I would say, scarce in the rest of the world. Abe administration support rate is still high, and the oppositions are trying to, coordinate and rally. However, as you see, it's very difficult to challenge this strong administration, and that's really exceptional in the rest of, in this world. If you look at Europe, of course, if you look at, obviously US, other parts of the world, it is becoming exceptional. And yes, I do think this is contributing to Japanese yen's safe asset status significantly. And then on the negative interest rate, QE, and potential impact, I would say at the moment, at least, it's very difficult for the BOJ to really prevent yen's strength by itself. I mean, global factors can reverse the trend, but at the moment, the BOJ is probably not so powerful. Take negative interest rate, for example. Whatever its long-term implication is, what the market is kind of assuming is it's not really effective immediately. And as I said, unless the global conditions improve, it's going to be difficult for change market psychology on the effectiveness of the negative interest rate. And then BOJ has 2 other dimensional tools: qualitative expansion and quantitative expansion. Quantitative expansion is supposed to crowd out investors' money from Japan and into foreign assets. So theoretically, this should be negative for Japanese currency. However, at the moment, as you said, David, the sustainability of quantitative easing is becoming a key issue. So yes, the BOJ can expand QE, quantitative easing, but it's going to have 2 conflicting implications for the immediate impact and its sustainability. And at the moment, I think the latter is a serious problem. So I don't think it's going to be effective. Lastly, qualitative expansion, buying more ETF. And this is quite a controversial policy from the very long-term perspective. Can the central bank keep buying your equities? Putting aside that problem, when we just focus on the immediate implication on the equity market and currency market, of course, if the central bank buys more equities, it has positive impact for Japanese equity market. But the problem is, as I said, the problem is not Japanese at the moment. It's global. So unless you believe higher equity market boosts Japanese demand, and this will save the world, I think the impact will be short-lived. And theoretically, bond buying by the central bank crowds out investors' money, but equity buying by the central bank probably doesn't crowd out money out of Japan. It will probably crowd in foreign money into Japanese market. So yes, a correlation suggests higher equity probably weakens the currency, but if you look at the pure flow dynamics, it's not really negative for the currency. So all in all, the BOJ's three-dimensional tools will probably have implication over the long term, but when we limit the discussion to 2016, I think it is not as powerful, at least as before.
Ikeda-san, so what happened if BOJ...
Okay, first, answering to the first question regarding the geopolitics. The UK referendum, this is having some very big implication for the Japanese yen, because if the UK departs from the EU, there will be some destabilization of a financial system. Therefore, it will also make it very difficult for the Federal Reserve to do a monetary policy normalization process in the latter half of this year. Therefore, then it's reasonable to expect both British pound and US dollar will be sold, and probably against the Japanese yen and the gold and probably Swiss franc. So it's really interesting to observe the impact of a geopolitical event. Like, for example, what I observed several weeks ago was when Brussels was attacked, the immediate reaction of the FX market was setting off of British pounds more than euro, okay? Because people thought about the UK departure from EU. And at the same time, massive buying of gold and the Japanese yen at the same time. So it seems as though one of the reasons why yen strengthened is associated with the potential market concerns about the UK referendum departing from the EU. Talking about the second issue around the BOJ's JGB purchase sustainability, I think now the BOJ has more room to buy JGBs because of the negative rate policy. If you remember why the BOJ was able to accelerate the asset purchasing pace from 50 trillion yen to 80 trillion yen, that was because of the GPIF's commitment to start selling JGB to buy more risky assets. And the same kind of thing is going to happen, in my opinion. So it's not GPIF. However, private institutions will be forced to sell JGBs because of this negative rate policy. Therefore, I think the BOJ will be given bigger capacity to purchase JGBs. Therefore, I think the expansion of JGB purchase program from 80 trillion yen to 100 trillion yen or something like that will be a feasible option for the BOJ. Of course, it cannot, of course, buy JGBs forever. There will be eventually some limitation. And then, so the key question is, will the BOJ need to buy up all those JGBs? I don't think so. As long as you have a good impact to lower real interest rates in Japan, there will be, of course, positive impact on the asset prices and also investment behavior in general. Therefore, I think the BOJ's main focus will be eventually shifting from the, and I would say, quantity to real efficacy of the policy easing stance. And that gauge will be potentially the real interest rates pushing down by the BOJ. And on a more practical manner, I think the BOJ can also start purchasing local government bonds. If you remember how ECB delivered a comprehensive easing package in the last policy setting meeting, it was not just a cut of interest rates, it was not just the expansion of the asset purchase pace, it also included the corporate buying program newly installed. So I think in order for the BOJ to impress its commitment and the willingness to have as accommodative as possible to the market, I think local government bond purchase should be also investigated as a practical alternative. Finally, with regard to the market impact of the additional easing by the BOJ, as Yamada-san briefly mentioned, I think it will be also depending on the market situation. And however, I tend to think the economic situation is improving greatly from March. January, February, it's a season for Chinese economic confusion because of the New Year holiday season. But from March, it's a very clear signs of China economic stabilizing and also U.S. economic activity gathering momentum again. Therefore, in this basically positive economic situation, I think the BOJ's additional easing will be fairly, I would say, powerful to have good impact on the dollar-yen exchange rate. In particular, if it's a comprehensive delivery of policy accommodation, it will at least, I would say, encourage, or I would say force speculative positions to unwind. And that will lift the dollar-yen level to above 115. So that's my understanding.
Okay, so probably the next expansionary move of the Bank of Japan will take the form of expanding asset buying and not pushing interest rates in a further negative territory. Right?
I think both. So lower interest
both.
rates
Also
and
both.
yes.
Any other question, please?
Kevin Buckland, Bloomberg News. Thank you very much for today. I wanted to ask about intervention a little bit more. Both of you actually talked about levels 100, 105 as potentially being key. I'd like to get a little bit more detail about your views on that, both of you. And also, generally, we talk about the idea that it's the speed of the move rather than the absolute level that's important when considering intervention, although there's been a lot written by Bloomberg as well as others potentially about how evidence shows that the level might actually be more important. I'd like to hear your views on that. Thank you very much.
All right. So as long as Japan belongs to G7, any intervention will require approval from the U.S. And 110 is a very unlikely level to get go from the U.S. The OECD assesses the purchasing power parity suggests the equilibrium level for the dollar-yen is 105. So at least until breaking below 105 level, it will be very unjustifiable for the government, Japanese government, to ask for approval from the U.S. And talking about whether level is important or speed is more important, I think one very important element on top of level and speed is whether it's being really driven by speculators or not. If any appreciation of the yen value is coming from the recovery of the economic fundamentals, or the, I would say, rapidly improving trade balance, etc., it will be, again, difficult to justify intervention action. So far, in this, I would say, by this standard, I think the government can think about intervention. But the problem is it's still too high in terms of the level. So all in all, my assessment is, first, the level is important And the second, whether it's speculative or not, will be also important. And usually, when it's too speedy, it's a sign of a speculative move in the FX exchange market.
My name is Kurt Sieber. I'm an associate member. I have a question, or two questions actually, on the stock market. The stock market has now been going down for 7 days in a row, the Nikkei. And where do you see the stock market going, and what is the position of foreign investors? Are they coming to Japan, or are they selling off in Japan, which also has an influence on the foreign exchange rates? Thank you, and thank you for the presentation. It was extremely interesting. Thank you so much.
Okay, so maybe I can start on this question, and a very good question, given how the equity market is influencing the FX market and vice versa. The foreign investors have been selling Japanese equities massively. This morning, actually, we just saw the first positive flow into Japanese equity in the weekly statistics, which is probably encouraging, from the flow perspective. And I'm not an equity strategist, so I can't really touch on this extensively. However, given how equity and dollar yen are closely correlated, we can think about the whole buy Japanese equity and sell Japanese yen trade as a package. And I think for all the reasons I described earlier, it is going to be a little difficult for Japanese market to attract money unless the level adjusts significantly. And that level may be the current level or slightly lower or much lower. That needs to be determined by our equity team. But the level is important for this year. The momentum is weak. And I think what could be interesting is how foreign community or investment community takes the political situation in Japan. Back in 2014, it was, basically the snap election was unpredicted, and that led to kind of acceleration of the Japan trade, buying Japanese equity and selling yen. But obviously this time is different, as you see in this slide, on the right-hand side slide. You see the upper house election this year is going to be the last scheduled election for Prime Minister Abe, and it could be a double election. And we all know that the founding reason of the LDP, as well as Prime Minister Abe's, I would say, personal political goal is constitutional revision. So I think it's going to be interesting how this election plays out and how this result will impact policy priority of the Abe administration. Is it going to be, will political capital be thrown into constitutional revision, structural reform, or reflation policy? It's a great question, but I think given the political uncertainty, it's the first reaction is increased uncertainty, which foreign investors are usually sensitive to.
Okay. From my side, I tend to think today's stock market situation in Japan is a little bit behaving too pessimistic. The economic momentum in Japan is apparently now downward. But we should always remember there is a time lag between Japan's economic situation lagging behind the US and China. And therefore, I'm fairly optimistic about the recovery of the Japanese economic momentum as well going forward, probably from the summertime this year. And talking about the policy responses, it will be probably easier to have a good impact on equity markets rather than to weaken the Japanese yen if the BOJ's acceleration of asset purchases or ETF purchases is announced, etc. So I think the chance is greater for Japanese stocks to go higher from here rather than devalue from here. I think today's level is a little bit too low.
Okay, any other question? So maybe I have another last question is why the Japanese government is so obsessed with a weak yen? I mean, after all, I mean, the export volume have not really improved. And yes, big corporations earn more money, but they are not investing enough in the domestic economy, in the investment in fixed asset level or raising salaries. Maybe they are raising dividends that goes to foreign financial players for 40% or so of the amount. So, I mean, will a yen at 90, 95 level toward the dollar so devastating for the Japanese economy or not, in your opinion?
Okay, so from my side, still Japanese corporate profit is positively very sensitive to the dollar-yen exchange rate. So always weaker yen will be tailwind for Japanese corporate earnings. Of course, there was a period when the government was a little bit reluctant to see further depreciation of the yen around March to April last year, when the dollar-yen level was already very high, and also oil prices were not so as cheap as of today. So at that time, I think the government was a little bit concerned about the negative implication of depreciation of yen too much, causing the high level of import prices, which is not very, I would say, friendly to Japanese ordinary people. And at that time, the government was in the middle of the local government election. But now I think there is no negative implication of the depreciation of the yen because oil prices are already very cheap and are very unlikely to have impact on import prices in the case of some depreciation of the Japanese yen. And always yen weakness is good for higher inflation, which the BOJ is really wanting to achieve. So this is the reason why I believe the government is and the BOJ is obsessed to weaken Japanese yen.
You want to add last?
Sure. I think quickly, Japan suffered from deflation, and whatever the truth is, the one assumption is that stronger exchange rate was, strengthening real effective exchange rate in Japan, and deflation was adjusting against the dynamics. So the Abe administration is on the reflation camp on the Japan's political spectrum. So naturally, weaker yen is one very important tool to tame deflationary pressure through nominal depreciation of the exchange rate.
Okay, so let's bring to the end this very interesting questions, very interesting, even if we still, maybe we don't know to bet or not towards stronger yen or a weaker yen, because our experts were both so convincing and made such a smart case for in different direction. Last but not least, I will give them a 1 year free membership of this club. So please, if you can come to our bar and maybe talk with the members of our club. And so just let's end with this session with a warm thanks to Mr. Yamada and Mr. Ikeda.
I will check with compliance.
Okay. Thank you.
Thank you very much.
Thank you very much.